Courtney. Well, good afternoon, everyone. Thank you for attending this amazing webinar that we have with a great guest that has been graciously agreed to spend an hour with us here at FAMP. I'm Linda Knowlton, your education chair for this year, and I am honored to introduce Douglas G. Duncan, who's the Fannie Mae Senior Vice President and Chief Economist. And before I introduce him, if you would all keep your screens. You can show yourself, but have it on mute. Any questions, just type them in the chat box and we will handle them as we go or towards at the end, because Mr. Duncan has an incredible presentation with a lot of great information here for us today. So it is my honor to introduce Douglas G. Duncan, who is the Senior Vice President and Chief Economist of Fannie Mae, where he's responsible for forecasts and analysts of the economy and the housing and mortgage markets. Duncan also oversees strategic research regarding the potential impact of external factors on the housing industry. Under his leadership, Fannie Mae's Economic and Strategic Research Group, called the ESR, earned the 2022 Lawrence R. Klein Award for Blue Chip Forecast Accuracy, recognizing their industry-leading work over a full-year period. Named one of Bloomberg Businessweek's 50 most powerful people in real estate and Inman News' 100 most influential people in real estate, Duncan is Fannie Mae's source for information and analysis on demographics and the external business and economic environment, the implications of changes in economic activity on the company's strategy and execution, and for forecasting overall housing, economic, and mortgage market activity. Prior to joining Fannie Mae, Duncan was Senior VP and Chief Economist to the MBA, Mortgage Bankers Association. His experience also includes work on the Financial Institutions Project at the U.S. Department of Agriculture. Duncan is a Hoyt, I hope I pronounced that right, professional fellow at the Homer Hoyt Institute. He was chosen at the North Dakota State College, University College of Agriculture Alumni of the Year in 2018. He was also elected as trustee of North Dakota State University in 2022. Duncan serves on the board of directors for Servium Care Network. Duncan received his PhD in agricultural economics from Texas A&M University and his BS and MS in agricultural economics from North Dakota State University. So welcome, Doug Duncan, and take it away.
Thanks, Linda. Thank you for the invitation and for the very nice introduction. On that last point about North Dakota State, I have a sweater on today because I'm heading up to North Dakota State as soon as we're done with this presentation. So it might be a little warm for Florida, but not so much for North Dakota. So glad to be with you. So each year in January, we go through an exercise where we try to figure out what's the most likely driver for the economy and housing, and then come up with a brief statement that we use to judge ourselves across the course of the year to see whether or not we understood what some of the impulses were going to be and factors that would drive the nature and level of activity both in the economy and in housing. So this is our theme for the year: housing seeks balance amid economic uncertainty. So just to take that apart a little bit, economic uncertainty always exists because we don't know the future. So that's not new to say amid economic uncertainty, but we've highlighted it because this is probably the first time in 50 or 60 years where there has been the significant level of global geopolitical strife that we're seeing with the war in Ukraine, the war in Gaza, with the threats to shipping through the Red Sea, with the tensions in Southeast Asia. It's probably been 50 years or more since we've seen that magnitude of distress and its impact on the global supply chains that have developed in that 50 years or so. And certainly that had an impact on the way our central bank thought, some of the issues related to fiscal policy through the government's tax and spend policies. So we're simply saying that the variation of views is likely to be wider in the current environment than in any time recent, including the after effects of COVID, which are still reverberating through the economy. So we wanted to make that point. The second thing is we didn't use the word normal anywhere here because we don't think we're anywhere near anything that's normal or sustainable for a time period. So what we talked about in housing is balance. That what housing is actually looking for some balance. It's been unbalanced by both COVID changing behaviors and choices related to the geography of where you work versus where you live, and the nature of your employment in that environment, and also the issues related to supply. So let me just give you a couple of quick snapshots of that might give you a sense of what we're thinking about. So if you go back about a year, the first time that mortgage rates passed 7%, there was this pause of new issuance in the mortgage-backed security market. The mortgage-backed security market is the source of funds that provide support for most of the lending that lenders do to consumers. And so the question is, why would there be a pause in new issuance? Well, the reason is that the Fed's move to raise interest rates in an attempt to tamp down inflation had risen rates to the level where investors did not believe an MBS backed by 7% mortgages would still be there as soon as the Fed started easing interest rates, that security would prepay because all the loans behind it would get prepaid as people refinanced away. So what did we see happen? We saw mortgage lenders start to offer 2-1 buy downs, and we saw builders start to offer permanent 1% and 2% lower interest rates to buyers of new construction. Well, interestingly, historically, the client of a builder tends to be a move-up buyer, and so the offers are attributes of the house, like granite countertops and finished basements and things like that. But the fact that boomers are doing what they said they were going to do and staying in their homes means that the supply issue for new buyers is much more heavily weighted toward new construction today. And the problem of a first time buyer is not the attributes of the house, it's the affordability of the house. And so builders understood that the financing was the biggest challenge for a much bigger share of their business these days, which comes from first-time homebuyers. So that's a place where the house is out of balance, or the housing market is a bit out of balance, in that the share of new construction that's being purchased by first-time buyers is significantly higher than is typically the case. Another example of the dislocation of things is in the work from home question. So on the day that your boss, or if you're a boss, you told your employees that you can now work from home for the foreseeable future, several things took place. First, that was a real increase in income to that worker who now works from home, because all of what used to be commuting costs convert to cash and disposable income because you no longer have to dedicate those resources to commuting. So you got a real pay raise. Now, if the boss tells you, okay, it's time to come back to work, you're going to receive a real pay cut because you have to absorb those commuting costs again. So it shouldn't be a surprise there would be some resistance to going back to the office. But there were other components of that transaction that were important as well. For example, you agreed implicitly for the opportunity to work from home that you would provide your own office space in that house. So it raises a question about whether the intrinsic value of your house has changed, because now it's not just a residence, but it's also a place of work. mind you, the business for whom you work still is probably leasing or owning workspace, which now sits idle, but yet they still have a financial commitment to. So they're probably going to do a calculation that says, with this adjustment in real income for our workers, what do we see in the productivity of those workers? Does our picking up this lost value in the property that we have where they used to work get offset by an improvement in productivity, which justifies the additional income that they're getting? I think that's an open question that it remains to be determined. But I just wanted to give you a couple of little tableaus of what's happened in the market up front to give you an idea of why we're talking about housing seeking balance. So it's clearly yet to be determined how that will work out. And you've seen in the office space question the challenges of some of the small and mid-sized banks, which have significant investments in lending to commercial office space properties, some of which are seeing significant declines in value as a result of this change. So I thought it would be helpful, perhaps, just to give a little bit of context. I actually, the other thing I was trying to do is to prove that economists can be linguistically clever, I coined this phrase about the geospatial redistribution of real estate value. And it just kind of falls off the tongue, but it hasn't been picked up a lot in the press. So I don't know, I might have to redo that. But it's basically that we're reorganizing the value of real estate based on its location, whether it's working at home, whether you are or not going to the office. All those value shifts are taking place. All right, next slide. This basically says Fannie Mae will deny I was ever here. Next slide. Disclaimers are boring. Next slide. All right. So the economy is doing pretty well. It's doing better than we had anticipated. You see there in the middle of the chart, those two bars that are below zero. And then you see some pretty short bars. That was about a 2-year period where our expectation was the economy was going to go into recession. As it turns out, it did not. The two bars that are below zero actually are heavily driven by what was taking place in the goods part of the economy, things like housing, things like automobiles, the hard products. There was no question a slowdown in that space, but the transfers that were made to households to keep consumption up in the services space on average kept the economy out of recession. And it's doing pretty well right now. Our view is it's going to slow, but we took the recession out of our forecast a couple of months ago as we saw that pickup in the third and fourth quarter of last year. Next slide. We have been watching employment if you line up these bars to the ones on the previous page, the orange part here is government employment plus healthcare, and the blue bar is everything else. So you can see we got very close to job loss in the goods part of the economy, but it was overweighted by the services part, which includes government and healthcare, which helped keep us out of recession. And now there's a fair balance between the private and public sector employments. We would expect to see some slowdown in the government employment numbers as some of the state and local government transfers that were done during the pandemic expire at the end of next year. Next slide. So in the midst of this, nominal wage growth has been slowing, but inflation has been slowing faster. So in terms of real incomes, there has been some pickup in real incomes. But if you talk, for example, to my Uber driver, and he asks, what do you do for a living? If you tell him you're an economist, then he gets mad about inflation. And why does he get mad about inflation? Because I asked him, I said, so explain to me what you mean. And he said, well, I go to the grocery store and prices went way up and they have yet to come down. And I said, and I'm guessing that your income hasn't caught up to that increase in prices. And he said, yeah, that's absolutely true. Well, so that gives you a difference, gives you an insight into how the public thinks about the conversation about inflation. Economists think of inflation as the rate of change in the general price level. So if you average across everything, how fast is that general price changing period over period? Well, okay, that's a reasonable way to think about progress or lack of progress against inflation, but it sort of ignores the household on the street and the impact the way that they see it. That's part of the reason that you see the public is still very upset about inflation, is their incomes have not caught up to prices, which have not come back down. Next slide. So there's a bunch of indicators that suggested there would be a recession. This, I just picked one, which is temporary employment, which is always a leading indicator of a recession. What you can see is temporary employment is falling at the present time, and yet we're not seeing a recession on the horizon. There's like 7 indicators that I traditionally had watched, all of which had been signaling recession, and yet we have not seen a recession. This is why we're not using that word normal, is because the indicators that have traditionally been useful are not being useful in this environment. Next slide. This simply breaks households into quintiles. Um, uh, so you have 0 to 20%, 20 to 40, 40 to 60, and so forth of income, and where is their savings. So you see that for the bottom income group, their savings are gone. For the next group, they're close to gone. But for the top 3 groups, still some substantial savings left over from the transfers during the pandemic. The other thing that's not captured here, as you are well aware, there were a huge volume of households who refinanced their mortgages from, say, 5% down to 3%. That didn't necessarily go into savings, but it did free up significant cash flow for consumption. So those two things together have kept the consumer in the game for a lot longer than expected and kept the economy out of recession. Next slide. There is now some pickup in delinquent balances on both auto and credit cards. Those represent some risk to the economy, but they tend to be concentrated in the lower income categories, which is not necessarily the homeowning category, but more the renter categories. But it is something that's worth watching. It's not yet at warning levels, but it is something to pay attention to. Next slide. This looks specifically at revolving credit because households are not only using credit cards more, but they are actually carrying balances. And a household who carries a balance at 20% plus interest rates is probably a household that has some stress. And so we are watching that. Next slide. That this is the point about the 20% plus interest rates on the credit cards. Next slide. But if you look at financial obligations, including leases, rents, all of the payments that a household has to make, and average across all households, what you see is it's not really at a warning level at this point. There's not. This does not suggest significant concern in that space. we're going to talk about deficits and debt at the federal government. Part of the reason why we don't see the stress is all of those transfers that helped households lower their credit balances were deficit funded. So we've essentially transferred private debt to public debt. And that's why you're hearing the discussion about deficits and debt at the federal level. Next slide. So, in the midst of all that, of course, the rise in rates was to combat inflation. So, the yellow portion in this chart is housing's contribution to inflation. It has been the expectation that that would decline because rents had slowed. That has not declined to the degree that the Fed has found acceptable. They've actually produced a super core PCE. They talk about core PCE taking out energy and food. Then they talk about super core also taking out housing. I propose we do a super duper core and take out all the data, and then there won't be any inflation. That's economist humor. Sorry about that. Um, but the fact is that the inflation measure that the Fed cares about actually has reversed itself the last a couple of months. That's why you've seen interest rates in general and interest rates in the mortgage industry rise. And we'll talk a bunch more about that. Next slide. So let's go to the Fed. Next slide. The rates jumped in April. They actually started up a couple months earlier because the inflation reports, as I mentioned, were not continuing to decline, the ones that the Fed watches. And we got those two strong labor reports that I showed you on the chart of employment. Both of those things raise risks in the Fed's mind about whether or not inflation will continue on a downward path. And you've heard multiple governors speak now that we can be patient. The economy is doing well, so we can be patient. We want to make sure that we're continuing to maintain pressure on rates to continue the progress on inflation. And so if you go back to the December press conference that Chair Powell had, he basically took a victory lap, suggesting that the Fed had successfully engineered a soft landing. The market immediately, in the minds of investors in the financial markets, that meant lots of rate cuts. I think the day after the expectation of that press conference in December, the expectation was perhaps 7 interest rate cuts in 2024. Right now, the market has become more realistic given those strong employment and inflation numbers, and at present expects no more than 2 rate cuts. That's what we have in our forecast. For a very long period, we had 3 rate cuts in our forecast. This month, we reduced that to 2 rate cuts. And I would say that the risk is that there may be no rate cuts this year if the Fed does not see progress on the inflation numbers the way that they would like to see them. Next slide. This just shows you the difference between the inflation adjusted interest rates and nominal interest rates. And it's intended to show that it was only in the middle of 2023 that inflation adjusted interest rates became positive. So it's been less than a year that Fed policy in real terms has been tightened. So there's still time, still work to be done. Next slide. Now, of course, one of the things that has had an impact on the housing market has been the Fed's portfolio decisions, which included the purchase of mortgage-backed securities. So on the left-hand side, you see the Fed's holdings of Treasury securities. The light blue lines here is the cap of how much of their holdings they would allow to run off in a given month. The dark blue line is how much actually ran off. On the right-hand side is the mortgage-backed security piece, and it's the same. The light blue is how much they would allow to run off. The dark blue is how much actually ran off. And by ran off, I mean prepaid. Well, with all those 3% mortgages that all the people in this meeting granted to households, they are unlikely to pay those off anytime soon. So it's not surprising that the prepayments on mortgage-backed securities have not met the level that the Fed would like to see. Their portfolio is running off much more slowly than what they would actually allow. They talked briefly about that last month at the press conference, Chair Powell did, and in the minutes of their meeting, which are released about 3 weeks after, not about, exactly 3 weeks after they hold their meeting, there was there were comments on the discussion that they had about their portfolio. The expectation in the market is that in the next meeting, they will actually make a change in the portfolio policy. And the change that the market thinks they might make is to reduce the amount of runoff they're willing to accept from the 35 billion monthly, which is those light blue lines today, to half of that, or 17 and a half billion monthly. And any amount that runs over the 17 and a half billion, instead of being reinvested in mortgage-backed securities, would be reinvested into treasuries. So they would continue the decline in their mortgage-backed security portfolio, which they would like eventually to completely eliminate. Part of the reason why spreads have been wide in the mortgage space is the presence of the Fed's investment in mortgage-backed securities. The Fed is not an economic buyer. In other words, they did not buy mortgage-backed securities for the risk return characteristics. They're a policy buyer. They were trying to change rates and spreads in the mortgage space through their intervention. They're now trying to reverse that. So you will see some changes in spreads in the mortgage space as a result of that reversal. Next slide. This will be on the quiz. It's actually a chart that's designed to show you the difference between when the Fed makes an announcement about a policy change and when they actually implement that policy change. And the basic story here is it's when the Fed announces a change in policy that the market reacts. And when they actually put it into action, the market has already adjusted to that. So it's the announcement that's the key driver of change in the marketplace. So you can watch the next time the Fed has their press conference after the next meeting. I assume you all watch that anyway. That's from economist perspective, that's a cocktail party. That's probably why you don't go to economist cocktail parties. But anyway, we'll all be there listening to what policy change are they going to make, and then we'll watch the market react accordingly. Next slide. This is the budget deficit that I was talking about. So the straight red line that you see there is a regression line through the relationship between unemployment and federal deficits. And you can see from all the dots around that red line, they're pretty tightly bunched over a very long time period. So that it was very predictive that when unemployment rose, deficits would rise. And when unemployment fell, deficits would fall. That's because when someone is unemployed, they reduce their tax payments because their income fell. Businesses' sales fall, so business taxes fall. And there are some automatic stabilizers like unemployment insurance, some of which are deficit funded. So when the economy goes into recession, deficits rise. But historically, at the federal level, when the economy begins its recovery and people get jobs again, they start paying taxes again, businesses sales improve and their profits improve and they pay more taxes, and those automatic stabilizers aren't necessary as much and deficits fall. Now, what you see that's really important here is the march that started in 2015, where when we had very low levels of unemployment, which typically deficits would have been very small, we started this major expansion of deficits and federal debt, which has continued to today. That is a very concerning pattern. You can see the two very outlying years of the pandemic and all the fiscal expenditures that went with the pandemic. Nonetheless, once that was over, we returned to this pattern of, even though unemployment is very low, we're increasing deficits. This, in my mind, is something to consider with regard to where interest rates can go, because the federal government gets first bite at loanable funds in the economy because they're viewed as the risk-free borrower. And so when we talk about the yield curve, we're typically talking about the interest rate out into the future at which the government can borrow money. And as the magnitude of money that they have to borrow in real time terms increases, in my view, that will push up the underlying yield curve, which also holds up in mortgage interest rates longer. So this is something that I think is likely to get some discussion, although neither presidential candidate has expressed anything in this regard during so far during the beginnings of the election season. But the fact is that the interest payment on the federal debt, the amount of interest dollars expended this year, will exceed the Defense Department budget. That's kind of a significant event. So something to keep your eye on. Next slide. Usually I don't show that last slide unless drinks are going to be served. So this is our overall economic forecast. You do see that we expect some slowdown in economic growth across the course of the year, but still close to 2% growth for each of the next 2 years. Unemployment still staying down in the 4% range, which historically is a very good level of unemployment. But you'd see there also that we do not expect the Fed to get complete control or inflation rates back to their target of 2%, even past the end of 2025, which suggests that interest rates will stay higher for longer. And so we have, at the end of 2024, we think somewhere around 6.5%, maybe 6.4. It really depends on what happens with the inflation measures as the Fed watches that. That has everything to do with where interest rates in the mortgage space will go. Next slide. So talk a little bit about housing, and then see if we have questions at the end of that. Next slide. This is the demographic profile of the U.S. population. Each of these vertical bars is a 1 year, the number of people that are of that year of age. So how many people are 30 years old? How many people are 31 years old? How many people are 32 years old? You can see we're not yet at the peak median age of first-time homebuyers within the millennial cohort. And you can see even after the millennials, things still look pretty good. And if you go further back, even the amount of immigration that we're having actually makes the demographic profile look quite strong for quite some time. This is part of the reason that you're seeing house prices appreciate as much as they are, because the people out there in the 60 and over category who have about an 80% homeownership rate have no intention of moving anytime soon. So the supply issue is on the back of the builders as opposed to the current existing homeowners. We did a survey of people 60 years and older who are homeowners to actually ask them, what are your game plans? It's up on the website. Feel free to go out there. It's we don't have a paywall, so any of our research is out on the website. And they basically told us we're intending to age in place. There's a small share, I think 17%, that had moved, downsized perhaps already. There was another share, something like maybe 30%, that said maybe at some point we might move, but over half said we have no intention of ever moving from where we are. So that suggests there's going to be continued pressure on builders to fill in the supply gap, which our estimate is somewhere in 2 to 4 million. There are estimates as high as 6 million units shortage, both rental and owned properties. So the supply issue will probably be with us for some time. Putting with this demographic picture, that means upward pressure on house prices um, uh, for the foreseeable future. Next slide. So you can see what those mortgage rates have done to affordability. This gives you an estimated monthly payment for a new mortgage, which does not include insurances and taxes, both of which are rising and have entered the discussion from a public policy perspective. So you can see the dramatic shift in affordability, the reduction in affordability that has taken place post pandemic. And it's hard to see that reversing itself anytime soon. Next slide. Yeah, I thought this is my favorite slide from last year. I call this, I haven't picked one yet for this year. I call this the barbed wire chart. I grew up on a dairy farm and I had to put barbed wire up on fence posts. It's not fun. This is not particularly fun either. The little dotted line that you see, the smooth dotted line underneath that, which says 1984 to 2019 trend, that is charting the relationship between the median existing home price divided by median household income. That's the vertical axis. So that's the theory that for if you have a certain level of income, there's only so many multiples of that income that you could afford to pay for in terms of price of a house. Rule of thumb, crudely, in the past used to be you could afford roughly 3 times the house price as your annual income. Uh, that's that's crudely. The horizontal axis says yes, but if you have to borrow money to buy the house, it depends what interest rates do. So the higher interest rates are, the less high the house price can be relative to your income. As interest rates fall, you can pay a little bit more for the house. So that's basically what that line does. And as you can see, the actual activity that takes place is very solidly on that line all the way up to the great financial crisis. You can see the departure there in 2002 in the bubble. Then you can see the bust, which takes place 2008 to 2009. You can see the bursting of the bubble. Then from 2014 out to 2019, we were right back on that line. And then the pandemic hit, and you can see how far distorted away from that relationship we are currently. So there's basically 3 ways in which you can get back to that line. One, interest rates can come down, which is why people are waiting for the Fed to cut rates and after they get inflation under control. The second one is that house prices can come down, but I just showed you the demand demographic and told you what the boomers are saying they're going to do. So that's where house price comes from, is that supply and demand intersection. And the third one is that incomes can rise. And incomes are starting to rise. That's why you see that 2025 number coming down a bit. But we're gonna have to see rates improve, supply improve, incomes improve to get us back to that long-term relationship, which I would call normal. That would be that smooth line down that blue line. I would say is something you could refer to as a normal relationship. So I wish I had better news, but that's kind of where we see things at the present time. Next slide. So you know about the current story on existing sales. You saw that they pulled back. There was a significant jump a couple of months ago. They pulled back a bit this most recent month, as we expected. New home sales came out today. They're going right in line with our forecast of a gradual improvement over this year. We also see a gradual improvement in existing home sales, but it's maybe 3 or 4%. Our surveys of consumers suggest they are coming to terms with the fact they're not going to see 3% mortgages again in their lifetime. They may not see 4% mortgages again in their lifetime. If you look at mortgage rates from the end of World War II, when the VA was put in place, out to about the year 2000, the average 30-year fixed rate mortgage was about 5.9%. So if I were suggesting what the cycle, what mortgage rates in the 30-year fixed rate category would be over the housing cycle, if things get back to normal, I'd say a range of 4.5 to 6%, with maybe a median of 5.25 to 5.5, somewhere in that ballpark. If incomes are rising, that's plausible. The people forget when in 1979 and 1980, when mortgage rates were 15 to 18%, there were still home sales, and people still took mortgages. It depends on what's happening with incomes, wealth, and other household factors. The number of transactions was down dramatically, as you would imagine, but there were still transactions. So there will be an adjustment to this new interest rate environment. Next slide. So just a couple things about Florida, comparing them to the U.S. They're pretty closely aligned with what's going on in terms of the existing home space. People in Florida, I would say there's a little bit more on average of second homes in Florida, so there might be a little more liquidity in that space than at the U.S. level, which might be why it's just slightly higher in Florida in terms of existing home sales than elsewhere. Next slide. This will be on the quiz too. I'll ask you, when did the pandemic hit? See if you can figure that out. But what you see is the work from home impact, and it combined with the boomer aging in place. You can see that the supply of existing home listings is dramatically lower than it has been for a long time period. So it's still going to be on the back of the builders on the new home side to close that gap. Next slide. There has been a much more of a pickup in active listings in Florida than at the national level recently. It's certainly not a kind of a hockey stick increase, but it's easy to see that there has been some pickup in single family listings using the Redfin data, which doesn't cover everything, but it gives some indication. Next slide. You can also see that in the Cape Coral area, which is where I live, there's been more of a pickup in active listings in that place, but a lot of Florida has seen a pickup in listings, as that prior chart demonstrated. Next slide. And if you look at the entire U.S., There's more of a shift in bright price declines across the South than in the Northeast. Part of that is simply the recognition of households that they missed the peak when mortgage rates were at 2.5 to 3.5%, and demand was very strong because of the work from home impetus, and people moved forward in time, putting huge pressure on limited supply and drove prices very high. So people are recognizing they're not going to get that price. This is not suggesting that people are losing money on their house. They're not selling for less than what they paid. They're selling for less than the peak in the market at which in which they're operating. So house prices in our forecast rose about 7% last year. So they were actually house prices were actually up. They just weren't up nearly as much as they were in the two prior years. And we do think that this year they'll be up somewhere around 4% nationally. So in some markets, house prices might actually decline, but nationally, an average of around 4% in our current forecast. Next slide. And so that my staff are just picking on Cape Coral because that's where I live. And I told them, I said, well, okay, so I'm getting older. The kids here call it God's waiting room. I can live with that. So, but so they clearly can see, and I kind of try to stay in touch with the local market, and you can see people relisting and bringing their listing prices down. That, however, does not mean they're losing money on those houses. Next slide. Obviously, a lot of people locked in interest rates well below what current market rates are. We surveyed people and asked them, is it interest rates going to keep you in that house? And about 20% of them said, yeah, that's true. But a not much larger share said, well, that's one incentive. But we moved to a house that we liked during the pandemic, and we didn't plan on staying in this house anyway. The interest rate is a nice plus for that, but it's not the sole driver. So that study is also up on the website if you would like to read through that. Next slide. So there's been a little bit of pickup in home equity loans. There's a lot of equity in houses out there. We don't anticipate that this is going to be a huge boom in that area because, of course, some of the tax laws were changed with regard to the deductibility of the interest. There are some rules on that for how the equity has to be used. And in general, refinance activity, no shock to anyone here, is operating at very low levels. You really have to get back to mortgage rates down around 5% or even 4% before you see an appreciable pickup in refinance volumes. Next slide. I talked a little bit about house price growth. Next slide. I mentioned at the outset, new home first-time buyers have been a bigger share of first-time home buyers are a bigger share of new home purchases than has been the case for quite some time. Coming back to levels prior in the early 2000s. Next slide. The builders are still working. Starts and permits pulled back a little bit in March, but we anticipate the pace of permits suggests continued growth in the builder space. Next slide. The builders are recognizing that first-time buyer is probably looking at smaller square footage than a move-up buyer, and so the average size of new homes has shrunk, but it's nowhere near what used to be considered a starter home, 1,400 square feet. Last year, only 7% of new homes built were 1,400 square feet or smaller. That's a pretty amazing number, actually. Next slide. Consumers are had in our previous month shown some recognition that mortgage rates had come back a little bit into the 6.5 range. That's gonna. I would be shocked if our next month's survey does not show a reversal of that, given where rates have gone. Next slide. The only pickup in delinquencies really has been in the FHA portfolio. The GSE portfolios have remained very strong, very low levels of stress in the GSE portfolios. Next slide. This just shows the regional variation, which some of the South, the particular Mississippi, Louisiana, have traditionally had higher delinquency and foreclosure rates than most of the rest of the country. You are seeing some pickup in delinquencies up in the Northeast as well. Next slide. And so basically, this is our forecast. It's up on the website along with the commentary if you want to read through the comments that we have for this forecast. Bottom line story is you're looking at mortgage rates that are going to be in the over 6% range. It depends. We have 2 rate cuts by the Fed in the end of 2024. If those don't materialize, then that 6.6% is probably going to be 6.8 to 7%. And similarly, we have 4 rate cuts in 2025. If they don't materialize, those mortgage rates will be higher as well. And of course, if mortgage rates are higher, you should expect volumes both of sales and of mortgage financing to be lower than what we have in this forecast, which is, as I mentioned earlier, gradually increasing about 3 to 4% this year. So let me finish there. I saw there was a question: do I use Ford F-150 pickups to forecast mortgage activities? Well, I have a Ford F-150. It has a wrinkled bumper at the moment, which didn't make me very happy. But I don't know if it has as strong a predictive capability as it did back in the Great Financial Crisis. I think that's a reference to a conversation I had with the chief economist at Ford Motor prior to the collapse, in which she had convinced Ford to cut back on F-150 production because of the coming slowdown in construction in housing, and all of the small contractors in California using F-150s to carry their equipment from job site to job site. There was, I think, a YouTube story about that with Ellen Hughes Cromwick, who's a friend and a really good economist. So I haven't seen that at this point, but it's a good historical reference.
Okay, that was amazing. I do remember that on one of your webinars a couple of years ago that you indicated the Ford 150, and so did one of our viewers. So thank you. Thank you, Doug. Anyone have any questions? We have a few minutes for questions or comments, because there was a lot of information there that I think we all can take away and use.
I
Anyone have
saw
anything
somebody
you
asked
want?
about the charts, and they certainly you can distribute the charts. Yeah.
Yes, yes. We will be sending out a his Doug's PowerPoint presentation to everyone that's on the line. Yes, a copy will be shared with you. Doug, I have one question. You just right there at the end, you had a chart on delinquencies. Do you anticipate, or I mean, do you predict a surge of foreclosures and short sales here in the next couple years?
We do not. The bulk of households have a lot of equity in their home, and so even if they come under stress, they have a cushion there, and they also have an incentive to retain that equity. So we don't see that. However, you could see in the FHA portfolio that there is some stress increase in the FHA portfolio. Those are highly likely to be correlated with the uptick in auto delinquencies and credit card delinquencies. So there is some stress in the FHA portfolio, which, as you know, has a little bit different underwriting criteria than the GSE conventional conforming category. So certainly, if the Fed's has to actually increase and tighten further, it will raise the risk of a more significant economic slowdown, and it's job loss that's the biggest trigger for foreclosure activity. So certainly important to watch what the Fed is doing and intends to do.
Mhm. Okay, we have a couple questions here. Do you mind if I read them to you?
Yeah, please.
Okay, twofold question. Do you see the Fed changing their target of 2% to higher number? And then what is the strategy the Fed will use to reduce the balance sheet? If the balance sheet goes down, will that lead to potential capital Fed may put back into the market to make up the capital shortage?
So, okay, let me talk first about their 2% target. I do not believe they will move off the 2% target because they've really driven that point home. And in some regard, they would uh, um, lose credibility because they've been so strident about getting to the 2% target. Now, a little historical anecdote. The minutes of a Fed meeting are released 3 weeks after that meeting takes place. The transcripts, in other words, the person by person report of that comes out 5 years after the meeting. If you want to go back to the discussion of whether they should choose a specific target like 2%, July of 1996, in the transcript, there's a really interesting debate between Alan Greenspan and Janet Yellen, in which I would summarize, these are my words, that Chairman Greenspan essentially said, "You will be sorry for the day that you pick a specific a number." So would they move off this 2% today? They've invested a lot in that number, and that would really change the way markets think about them if they came off it. So I don't think so. With regard to the portfolio, they have an explicit policy statement, which you can read on their website, that they eventually want to eliminate any holdings of mortgage backed securities. Well, the question is, as they run the MBS portfolio off, who replaces them? And what yields, risk return characteristics do they require to replace the Fed as the holder of those MBS? It's part of the reason the market has been volatile, and that volatility has been built into the spreads. So it's an important thing to watch going forward.
Okay, all right, great, thank you. Danny Black, I see your hand up. Would you like to ask a question?
Yes, thank you, Linda. Doug, I think we're all concerned about the national debt. And do you think the lawmakers are continuing to just kick the can down the road, or do you think that they have a plan, or, you know, uh, trying to address that?
It's a great question, and to date, I've seen no. Certainly, between the two presidential candidates, neither has even mentioned the deficits in any meaningful policy statement that I've seen. Maybe I've missed it, but certainly within the House of Representatives, there has been discussion of that, but there's no consensus today about that. And I would expect for this election cycle, it's likely to get kicked down. The can will get kicked down the road. But as I mentioned, with all the geopolitical unrest there is globally, the fact that we're going to be paying more interest on the debt than the size of our defense budget is to me troubling. And if voters start to think about that and ask questions, I think perhaps that will stimulate some serious discussions on the Hill, but I'm not holding my breath.
Thank you.
Okay. All right. Well, we are at 1 o'clock, and we first and foremost, Doug, I want to thank you for spending your hour with us and all the great information that you gave us. You've always been a good friend of FAMP, and we really appreciate that.
Oh,
And we
thanks
hope
for
to
the
see you
invite.
again, absolutely soon. And we thank everyone that's on the call, and we thank you if you're FAMP members. If you're not, this is what your membership can bring to you and more. And we hope you consider FAMP in joining us very soon, because these are the type of information webinars and many other things that FAMP brings to our industry. So again, thank you all for attending, and Doug, thank you again.
You bet. Thanks a lot. Have a good day.
Good afternoon.
Thank you.